Welcome everybody. This is our first quarterly video of Markets in Minutes, where we're going to be going over what's been happening in the market over the last quarter, and then also different various topics within the economic sector. So we are taping at about 9:30 in the morning here on April 15th on tax day. So Mike, you want to talk a little bit about kind of how things started?
Sure.
And how they're going now?
Well, I mean, markets started off pretty solid. We had a pretty good start to the year. You thought everything was kind of off to the races again. And then actually, it's kind of weird. It doesn't seem like this whole conflict with Iran has been going on since the end of February.
Yeah, I think it was February 28th.
Yeah. S&P is up just under 2%. Pretty much the NASDAQ is as well. Dow Jones is at this point up about 1% from the year. So it seems like the market's kind of shrugging this whole Iranian conflict off and looking like it's going to be a more of a short-term thing opposed to some long-term event that's going to drag the economy down.
Yeah, I think the snapback is probably the most important thing from this situation. It's very similar to the tariff situation last year, right?
Yeah.
Where things were going poorly, and then all of a sudden, boom, we're moving in the other direction. I think if you were looking at your portfolio on March 31st, it probably would have been a horror story.
2 weeks later, completely different story now.
Completely coincidental. We did not schedule this taping specifically for when the market would be back off, but completely coincidental that things are on the upward swing, which is great. But it also just shows, the market is always really ahead of what is going on. It's been a wild 15 or so weeks to start the year, but to have positive on every major indices so far, NASDAQ, S&P, and Dow is pretty good.
Yeah, definitely.
All things considered.
Yep.
Mike and I go through charts and look at different stuff, and this one really caught my eye. And it talks about top 10 companies by size by decade. 2025, you look at that and it's 8 companies that are
top 10
that are tech, right? And then you have JP Morgan and Berkshire Hathaway.
Right.
Let's go backwards. Let's not even go to 15. Let's go to 05. You look at kind of Microsoft, right? Microsoft was on there in 05, wasn't on there in 95. Microsoft is carried from 05 to 15 to 25. But nobody's really gone the whole way, right? So Exxon attempted to. They were on the list.
They were close.
85, 95, 05, 15, but they've dropped off.
This is one thing that you hear on the news all the time, and it's the concentration of the S&P 500. You have such a big percentage of it is a very small amount of companies. And while, that is true, and that's a real risk, it's around 37%. This is something that's been going on forever. So even going back to look at 15, it's not as high, but you're still 20% of the market is 10 companies.
Mm-hmm. I don't know if it changes much to 35.
Right.
We'll definitely have some. It's not going to be the same 10 companies most likely in 9 years or 10 years from the 25 chart. But I do think that by 45, I think it's very different, right? So, when you diversify your portfolio, you can kind of mitigate this risk as well.
Absolutely.
Moving on just to economic sectors and what's been going on with inflation and the consumer balance sheet. Inflation has come down.
What is inflation coming down? What is disinflation versus what is deflation? And because when people hear inflation's coming down, you go to the grocery store and, things are still just as expensive as they were. But that's the difference between disinflation. Inflation's still positive, so it's still going higher, but at a much lower rate than it was in, say, 2022.
Yeah.
So that's important to know. So there has been a lot of progress made with inflation, and it has come down. It just don't expect to see, prices go negative. That's deflation, and that's a terrible thing to have because
it means nobody's buying.
Nobody's buying anything.
Nobody's buying anything, and we have deflation, and most likely means we're in a pretty bad.
High unemployment. Not good.
Energy is a big one, obviously. Right. Insurance. It's funny. Auto insurance is on this chart.
Yeah. Eventually, inflation takes care of inflation.
Yeah.
Prices get so high that
that's true.
People just stop buying.
That's
fine.
That's a really good way to put it. Inflation takes care of inflation. There is a lot of talk about kind of the strength of the consumer.
Mm-hmm.
and how things are going. And I feel like a lot of people always go back to like the 07, 09, right? Financial crisis, because that's what everyone is trying to avoid,
Yeah.
right?
A
Like,
lot of debt going on during that time. And yes.
you know, I look at this kind of in the top right-hand corner, household debt service, and percentages are really important. So if you see a headline that's like, you know, US consumers have the most debt ever.
Right.
And it's like, well, people make a heck of a lot more money than
Correct.
than they did in 1980, right? So they can afford a larger debt load. So to me, it's more about the percentage of their income that have to go towards their debt, right? So looking at this chart through Q1, it's about 11.3% of people's disposable income is going towards debt repayment. And if you look at like 07, 08, 09,
Yeah.
much higher.
Much higher.
We are technically in the last 5 years trending up, and the reason why is because during COVID, no one was really
Right. It's the numbers were skewed because there was nobody could go anywhere. You could, hardly buy things even.
The other area is in regards to delinquencies.
Yeah.
Mortgages are probably the thing that I pay the most attention to.
Right.
And mortgages are not high. They're 3.9%. And if you see, they're really still on that. They're before 07,
Yeah.
we were at 5+%, right? And we've been well below 5 for a while now.
For a while.
So with delinquencies of 30+ days on mortgages. So essentially right now, about 4 out of every 100 houses are a month behind on their mortgage.
It's a totally different landscape, though. I mean, most people have very low interest rates, fixed 30-year mortgages, much more manageable payments. So, yeah, the rise in student loans, I mean, we went from a period during COVID where they basically paused payments on student loans.
Yeah.
So I think as those payments kicked in, there was a lot of fuzziness, I guess, of getting loans canceled. Should I pay? Should I not pay? So yeah, it's definitely something that we're keeping an eye on.
I have heard over and over and over again, I've received emails about it. It's been a topic of conversation in meetings about AI bubble. The chart that we have up on here is 1, 2, 3, 4, 5 of the largest tech companies in the world. I believe all of them, going back to our list of 10 companies, I believe all of them.
They are all on the list.
Meta's on the list?
Yep, Meta's on there.
Okay, so they're all in the list of top 10 companies in the world by market capitalization or in the United States. And then we have the NASDAQ, which is the index as a whole. And this is, in the last 1 year, what stocks are currently off of their all-time highs as a percentage. And this is this morning, April 15th.
April 15th,
April
so going back.
9 a.m.
Yep.
Before the market opened. So the NASDAQ as a whole is 1.33% off its all-time high. I think the thing I would point out with the NASDAQ is that the all-time high date for the NASDAQ, do you know what it was?
Sometime in September?
It was October 28th.
Yeah, I could.
So if we don't get back to an all-time high in the next couple weeks, we've gone 6 months without an all-time high in the NASDAQ.
Yeah.
Would that tell you we're in a bubble?
No.
6 months of no. Okay.
No.
Nvidia is 5% off its all-time high. Microsoft is getting beat down right now.
Right.
Google's 3%, Apple's almost 10%, Meta's 16%. So first of all, these companies are all incredibly profitable. Incredibly profitable. They're not borrowing money to build their AI infrastructure.
Yeah.
But I think the thing with the bubble is that they're just not like this to me doesn't scream bubble.
No. I mean, and these are companies that, like you said, make products and services that are bettering business and the way we live our lives. It's not like they're just these fly-by-night companies that are pumped up, like going back to 2000.
Like these numbers, these headlines, these numbers that you see are so crazy, right? Like this much and this much and this much and this much. And certainly the market's going to want to see some financial results from the money that they're spending, right? But like, the fact that Meta is just like, the metaverse isn't working, we're out.
Yeah.
Bagging it, just 80 billion, just, it didn't really work.
Done.
Like, I don't think we can sometimes fathom how much money these companies have. So when, they're spending, capital expenditure 2026, 677 billion.
Yeah.
It's like, all right, first of all, that's 1, 2, 3, 4, 5 companies. Like, it's just not a big number when you think about how much money these companies make. And the fact that they're doing it from profits, it's not speculative. All right, so let's kind of close things out with just kind of a long-term viewpoint on things. And I think the first one I want to talk about is the annual returns and intra-year declines of the market. And I think it's very timely with what's happened over the last few weeks.
Yep.
These pullbacks are normal, right?
Yeah.
So the chart with the annual returns and intra-year declines, the bottom part of the chart shows you the low point of the market from a percentage. This would be the S&P 500 over the years, right? So in 2020 down 34% and et cetera. And then it shows how the market actually finished the year from a return standpoint. So like, for example, last year, the S&P was down 19. That was around the tariff time, and then it finished up 16. So
it's a big swing. Big news that, as it says, despite intra-year drops of 14.2%, you're positive like 75-ish% of the time. So these market moves are normal. They happen frequently. They have a way of feeling like the world's ending when you're in the middle of one.
yeah,
Again, a lot of that's, I think, news driven. But the moral of the story is just hang in there and just wait it out. It's a normal part of investing. They call stocks risk assets for a reason, because they go up, they go down, they're volatile, but it's just, those are pretty good odds right there. I was shocked when I saw this, how costly it was to just miss the 10 best days. I mean, if you just remain fully invested over this time period, you're looking at an 11% return for doing nothing.
06 to
going back 06 to 25.
Yeah.
So that period, you miss 10 days out of like a 20-year period, and your return is cut almost in half. That's wild.
Yeah. So,
But yeah, I mean, just look though. You see, when the market bottoms, those next moves are usually really big. Once investors and really the institutions start putting money back to work,
Yep.
that's when you see those big movements, and it's critical that you're invested during that time.
the average bear market is 14 months with an average return of negative 39%. Those are going to be driven pretty heavily by 2000 and then the financial crisis, right?
Yep.
But then your average bull market is 70 months
Yeah.
and is a 221% rate of return
Yeah.
on average. Looking at where we are now, we are 2022. I'm looking at this in black and white. Geez. I think we're 40 some odd months in, right? On average, I think, or somewhere around there. So it just shows that this could go on a lot longer than we think.
Yeah.
We want to thank everybody for joining us.
Thank you.
Like we said, the goal here is to do these videos on a quarterly basis and just really provide you with information. Try to just cut through the noise, right? I mean, if you watch financial news or if you read a lot of stuff online, a lot of that stuff is headline driven, and we really want to be data driven and going over things with you so you can be informed and be knowledgeable and be comfortable with your investment strategy. So thank you for joining us.
Thank you.